So if you think about factor investing, a key benefit that has been emphasized of factor investing is really the transparency behind this approach. So if you think about the early days of factor investing, when large sovereign funds and pension funds became interested in factor investing, this was one of the key motivations. So traditionally, asset management is not that transparent. An active manager will always try to keep some of the information to himself, because his value added is really the specific strategy and the specific process that he follows. But that obviously also leads to a conflict of interest between the investor and the manager. So the investor doesn't know exactly what are the factors driving the investment strategies. So one of the key benefits of factor investing that institutional investors were interested in is really the transparency behind this approach. So you actually know what the return drivers are that the strategy explicitly tries to capture. But of course, there's a downside to this transparency, and that downside is simply that, well, everyone knows what you are doing. Okay, everyone knows that these factors are there. And so things like value, size, momentum, and other factors have been very well documented for a very long time. And so the question is really, well, what happens when everyone knows about these factors? So should these strategies still continue to work, even though everyone knows about them? So there's a real question also whether there is not a problem with transparency. And if you look at the recent factor performance, you see that obviously I'm not telling you anything new here. Factor performance over the recent period has been quite low. So a lot of the factors have quite negative returns. What you see here on this slide is just a view on the short-term performance over time of 6 standard factors. So you can see that factors like size, value, profitability, investment, momentum, and also low risk all had a recent period with relatively poor returns on average. But you can also see that there is a lot of variability in general. So a common, I think, a common pattern that you see in discussions in the industry is that people try to make a link between a recent performance of factors and some effect of crowding. Okay, so everyone knows about the strategy, so maybe the benefits have disappeared. And so there's lots of talk about potential problems with transparency that could lead to crowding. Now, if you look at the claims about crowding, they are really very theoretical. So I think this is quite surprising. Usually you think that theory is done by academics in academic studies, and well, practitioners don't do theory. But actually, when you look at the industry discussion on crowding, it's really a very theoretical discussion. Okay, so you have some claims in the industry, and I just wrote down some of these claims here on the slide, and there's really no data, to back up these claims. Okay, it's just theory, so there may be problems with crowding. When everyone knows about these strategies, this could actually lead to adverse effects for investors. And not only isn't there any clear evidence, and it's just theory, but also the theory is actually not very explicit. So there isn't a clear definition of what crowding is supposed to mean. So for the purpose of this presentation, I'll try to make a simple distinction between 2 aspects. One is what I call overcrowding. So I'm referring by overcrowding to a general effect that would lower a risk premium. Okay, so we have evidence documenting a momentum premium, a value premium, etc. So premia have been documented. So if more and more investors are actually pursuing these strategies, the long-term expected return of these factor exposures could be lower, okay, than it has been in the past, and ultimately could disappear. So I'm referring to that as overcrowding. Now, this kind of overcrowding, if it exists, would be a problem really for any factor strategy in those factors, and pretty much irrespective of the implementation. Okay, so if the value premium completely disappears, then whichever way you implement value, you will actually suffer from this disappearance of the risk premium. There's a second aspect, which is much more specific and which relates to simply the very transparent implementation of these exposures in an index. Okay, so going back to the example of value, well, maybe the general value premium persists, but it could be the case that using a very popular value index, okay, to get your exposure to the value premium could be a bad idea, because in this popular value index, rebalancings are mechanical, they are completely transparent, okay, and so maybe you're suffering some losses because you're just trading along with everyone else in this popular value index. Okay, so you could ask the same question for the equity market premium. Okay, so overcrowding would mean, well, since everyone is trying to hold huge amounts allocated to equity, the equity premium disappears. That's irrespective of any implementation of holding equity exposure. Buying pressure is more specific and would say, well, if you hold these very popular cap-weighted market indices, then you have a loss, right? So even if the equity premium is there, implementing it with very popular market indices may give you a disadvantage, because there could be a lot of kind of trading pressure, buying pressure around the rebalancing dates of these indices. And so I try to look at both of these problems, so which I'm referring to as crowding for the first one and buying pressure for the second one. So let's look at crowding. As I said, the discussion is quite theoretical in the industry, so there isn't much evidence. What I will try to do is also start with some theory, but then actually go to the evidence. The very nice thing about factor investing is that, well, it's not theoretical, so it has seen increasing adoption by investors. So if there's crowding, we should be able to see it in the data. And so I'll talk about theory, but I'll also go to some evidence on that. So first, from the perspective of theory, well, we can ask, well, should these factor premia persist, or should they disappear if everyone uses them? And here, actually, the basic theory behind these factors is able to give us actually pretty clear indications. So factor investing is simply taking risks that provide a long-term premium, and there are two competing explanations for these. So there could be a risk-based explanation. Okay, so by tilting to value, size, and other factors, you're taking additional systematic risk exposures. And so even if everyone knows that there is a premium, this premium will still persist, because some investors will not be able to take on the corresponding risk. And so in a way, they'll be happy to forego the extra return, because they're happy to forego the risk that comes with it. And it's only some investors who are willing to take the risk, and so they can get their reward. Now, if this is the explanation of factor premium, then obviously they are likely to persist, and it's not because they become widely known that they should disappear. A different explanation is a behavioral one. So the behavioral explanation basically says, well, investors are not behaving in a rational way, and this irrational behavior gives rise to mispricing. Okay, so market prices actually don't, if you will, reflect a rational pricing, and so some investors can be smarter than these irrational ones and benefit from that. Now, if the explanation was purely behavioral, ultimately these premiums should still disappear as long as, or as soon as, you have some arbitrageurs, so you have some rational investors that could actually exploit these anomalies and ultimately contribute to them going away. So in addition, you would actually need some limits to arbitrage. So there has to have to be some institutional arrangement that limit arbitrageurs from fully actually making these premia disappear. So if there's a risk-based explanation, we actually would predict that if everyone knows about these premia, they shouldn't go away. Again, you can think about the market premium. Okay, so probably people know that on average, exposure to the equity market comes with higher returns than simply holding cash. But that doesn't mean that the equity premium should disappear, because everyone also knows that it comes with risk. And so this risk-based explanation is not purely theoretical. There's empirical evidence that different factors actually expose investors to additional risk. And so this risk is simply the risk of having losses in bad economic times, well, when actually positive returns are very valuable to investors. And so there is not just theory, but also empirical evidence that factor premium may align with these risk-based explanations. So that's just to clarify the theoretical background. Now, as I said, factor investing is not theoretical, so it's been around for more than a decade. So we should be able to see evidence of crowding if it has occurred. And so the question is, how can we figure out whether something has changed, and how can we figure out whether, due to popularity, these premium may have disappeared? So a popular way of looking at this question is to look at short-term losses. So I mentioned this quite often. People try to make a link between short-term performance and crowding. Now I'll just show some illustrations to try to convince you that short-term returns really don't give us any information about whether or not crowding has appeared. And that's simply because all of these factors will have short-term losses. And actually they are precisely rewarded because they are risky, which means that especially in bad economic times, we would expect some factors to have poor payoffs. There is substantial variation. And this variation leads, of course, to short-term losses, but this has nothing to do with crowding. So I'll just give you some illustrations on different factors to see what we can say on short-term performance. Now, perhaps more interestingly, we can also look at a pretty direct way to estimate crowding, and that is we can look at what happened after these factors have become widely known. So this is also called the post-publication returns. So there's a growing literature, so with a large number of empirical studies that try to figure out, well, has actually the risk premium come down for value, for momentum, after the effect was published? And so that should give us some guidance on whether or not there's actually crowding, and what are the effects of these factors becoming widely known. So let's look first at short-term losses. I'm showing you some of the popular claims here. So this is on momentum. So on momentum, there's been lots of talk over the past probably 2 or 3 years that there has been perhaps overcrowding in the momentum factor. Something is wrong, that the factor no longer works. Because if you look at this graph here, you can see that even the 15-year annualized returns on the factor have been 0. Okay, and so if you think that there should be that there's a premium, we would of course expect a positive return. And so then you have some commentators that are quick to point out that this could be because of the increasing popularity. Now, if you take this way of reasoning seriously, well, you should say that whenever there was a big loss to the momentum strategy, well, it must have been because of crowding. And so let's look at the long-term history. So we're looking here all the way back to the 40s. So you can see that in 1945, 46, there was a dramatic loss to the momentum factor. And so the conclusion then must be that there has been a lot of crowding in momentum factor indices. So apparently in the 1940s, people all jumped onto ETFs replicating the momentum factor. And so it must have been this crowding that has driven down the returns to that level. Of course, we know that that's not true. These products didn't exist in the 1940s. And what this just shows is that historically, we've had large losses in these factors. And that's simply due to the economic exposures of these factors. It just doesn't allow us to say anything about crowding occurring in these factors. Another factor that is often discussed is size. So on this graph, I'm showing the cumulative return of the size factor. And so on the size factor, there have been lots of comments in around the turn of the millennium, so in 2000, 2001. Well, what people did is they basically looked at the past 15 or so years of the US size factor. And returns had been weak. So you see that indicated here with the circle. If you look at around 2000, 2001, well, you've just seen a cumulative loss in the size factor that stretched over roughly a 15-year period. Now, it happens to be the case that the seminal paper on the size factor was published in 1981. So this is the famous Bunce paper on first providing evidence of the size factor. And so people were quick to say that, well, probably after the paper was published, people were widely aware of the effect. And then, since everyone knew about it, it had disappeared. The proof of this story is that looking at the returns in 2000, well, returns had been very low ever after publication of the factor. And so there's been different papers by economists arguing that we probably have seen the disappearance of the size factor, and this is a publication effect. Okay, since everyone now knows about it, the size factor has disappeared. But just to judge how sound this reasoning is, just look at what happened to the size factor before Bunce published the study in 1981. So if you look at the data before, well, a lot of this is data that is actually included in the study. Okay, a lot of this covers the time period actually covered by the study. And you can see, for example, that in the early 70s, there had been a drawdown to the size factor. You can see that from really the 1950s to the late 1960s, performance of the size factor had basically been flat. So there had already been periods where this factor had poor returns. And what this suggests is definitely not that there was crowding in a known factor. Okay, Bunce was, hadn't published his paper at all, and probably hadn't started any work on this topic. And yet we already had these drawdowns to stocks that reflect the size factor. And so what this just suggests is that there is a lot of variability in these factors, and that doesn't tell us anything about crowding. So we've conducted some analysis recently on linking this variability to macroeconomic factors. I'm just showing you some results here to illustrate this point. So it's actually widely known that popular factors have quite strong exposures to macroeconomic environments. So one result you can see here is that the low risk factor, for example, has a strong negative dependency on interest rates. Okay, so this factor will suffer when interest rates increase. Value is very sensitive to the term spread. Okay, so when the term spread decreases, that's typically a signal of a recession risk. The value factor tends to do poorly. That's quite well documented. And so what this means is that when you have these changes in the macroeconomic environment, you may have losses to the different factors, and that has obviously nothing to do with any crowding. So it's not a good idea to look at short-term performance to conclude on crowding. Then what can we look at? What is more reasonable? And I think a very straightforward and very pragmatic approach has been proposed since 2016. So there's a well-known paper by McLean and Pontiff, where they provide formal evidence on what happened to the factor returns after each factor was published. And so they actually provide formal evidence that publication does not cancel out the factor returns. So what they show in the formal statistical tests is that the premia to published factors in academic research have not disappeared after publication. Just to illustrate these results here, I'm showing you an overview of four main factors, four very popular factors that have been around for a long time. So size, value, momentum, and low risk were widely published in 1992. Okay, so they were already included at that stage in well-known papers in multi-factor models. So if you look at what happened after 1992, you can check out whether the premia look different to what they looked like in the seminal research. And you can see here the t-statistics associated with the differences in returns, and you can see that actually none of these differences are significant. So there's really nothing in the data, okay, that helps us to conclude that these risk premia have been lowered or have disappeared. Okay, so even in the post-publication period, these premia remain positive, and there's no significant difference with what happened in the seminal research. Now, I'm just also looking at a more simple illustration, just to show you what happened to factor returns after publication. So what we do here is we're not looking at individual factors. What we do here is we're looking at a multi-factor strategy. Now, this multi-factor strategy basically starts in the early 70s, looking at the low risk, only using the low risk factor. So that was already published in the 1970s in a famous paper by Black and co-authors. So we're just holding the low risk factor and we're waiting for the next factor to appear. And so that size appears in 81. So from 81 onwards, we're holding a 2-factor portfolio. We're holding that all the way to 1985. In 1985, there was the famous first paper on the book to market effect, the value effect. Okay, so now we're adding value. And so we're doing this as the seminal work on each factor appears. And so by 2004, we're actually holding a 6-factor multi-factor portfolio. So if you look at the returns to that strategy, so these are very significantly different from zero. So clearly positive returns over the full period. Now, none of this performance is due to using a factor that hadn't been published. Okay, at each point in time, this portfolio only holds factors that haven't been published. So this just gives you an illustration that is not that obvious that publication leads to disappearance. If a factor will mechanically disappear after it has published, it's difficult to explain where this performance of this strategy comes from. So really, I think the bottom line from this analysis is that crowding concerns are obviously important, and investors should ask the question whether this whole foundation behind factors is whether there's not something perhaps wrong with it, and haven't we missed the effect that once these strategies become known, they will change in their nature. So that's a legitimate concern, but then to address this concern, we shouldn't just look at storytelling, we shouldn't just look at anecdotes, we should look at the evidence. And again, the evidence is clearly that factor investing has seen a wide following over the recent years. So if there's crowding, we should be able to see the effects of this crowding by now. Another point I wanted to make is also that just because factor investing has become popular doesn't actually mean that there is more at the aggregate level, that there is, if you will, more interest in factors. So perhaps active managers have already been tilting to these factors for a long time, and the main change is that now investors can do that explicitly with low-cost indices, instead of leaving the factor tilts to an active manager who will do that with less transparency. So if that's the case, if you will, the aggregate demand for factors hasn't even increased. It's simply that it has shifted from active management to low-cost, transparent strategies. So that at least would be consistent with the fact that we haven't actually seen any impact on crowding. Of course, another important point is that if investors believe in a risk-based explanation of these factors, then there isn't any reason that these premiums should disappear, even if they become widely known. Just like you wouldn't expect the equity market premium to disappear just because people figure out that equity should have higher expected returns in the long term. Okay, so the question of have these premiums disappeared is an important one, and we do actually have a lot of evidence on this, and so I think it's important to look at that evidence, especially on post-publication returns. Now, a completely different question is the question of buying pressure. Okay, so perhaps there's something about the very transparent implementation in an index of these factor tilts that will lead to problems for investors. And so indeed, some have argued that what really factor product providers should do is they should just limit the transparency. Okay, they should be kind of secretive over the exact implementation, and definitely when they implement their rebalancings, they should not provide that information to the market. They should, they could have a much less transparent methodology and then just give information ex post to clients, but not give information ex ante, or not be entirely transparent to everyone in the market. Okay, so this is an important argument, and I think this argument is for a large part based on really a misunderstanding of when do price effects arise, but it is an important question. So is there really any reason to believe that this transparency of rebalancing the strategy will create any extra cost to people who track the index. So some background to this, there is a rich literature with quite consensual findings on actually cap-weighted indices. So cap-weighted indices also are transparent. Okay, so they change their constituents, and the question is what happens for investors if you're simply tracking the index. Do you actually have a loss due to that transparent rebalancing? And there's been evidence ever since the mid-80s showing that these popular indices really lead to abnormal returns. So additions to the index actually experience a significant abnormal return. So that means they see an increase in price, which is linked to the inclusion in the index. Okay, so it's called the index effect or index inclusion effect. And this has been shown initially for the S&P 500, but has also been shown for global indices from MSCI and other very popular cap-weighted indices. So initially, finance academics were describing this really as a market inefficiency, as some kind of anomaly, providing evidence that maybe markets don't work as expected. Because, from an economic perspective, you would think that simply because a given stock is now in the S&P 500, well, that doesn't change its risk return properties, and so it shouldn't have any effect on the price. Now, in the more recent studies, it's been shown that this index inclusion effect indeed results from a real benefit of index inclusion. Okay, so it's not an inefficiency. It's simply that being included in these major benchmarks is a big deal for companies. They derive some real benefits of benchmark inclusion because they are, they have the stamp of being a benchmark stock. Investors are much more aware of companies that are part of, say, the S&P 500 and similar indices, and that will help these companies lower their cost of capital, have easier access to capital markets, and so this is actually what increases the value when they're included in the index. So this is really a good starting point for thinking about what we should expect to happen with factor indices. And now in the case of factor indices, you see these arguments that providers should really limit transparency. But as I mentioned, I think this is based on a misunderstanding because this risk of, there's going to be some investors who front run the index. That is really a concept that comes from trades that actually reflect some private information, some proprietary insights. Okay, so if let's say the CEO of a company announces that he will sell a stock, well, we know the CEO has superior information about the prospects of the company. So you would expect that to have an impact on the stock price. But if a momentum factor index announces that it will increase the weight of a stock or reduce the weight of the stock, we know that simply because they have defined in the ground rules that they will look at some measure of past returns, then sort stocks in a predefined way. And so this doesn't tell us anything about the value of that company. It's just a mechanical inclusion. There's no private information, and there's a host of academic studies basically describing that in that case, with no private information, you don't have this price effect that you just wouldn't expect a price effect. And so that also means that what factor indices should do is really they should announce their trades. And so this has been argued in a paper by Petayistos. We basically said there's two things you need to achieve. First, you need to signal that really you don't have any special private information. There's nothing that the market doesn't know, because if you make that credible, then liquidity providers will be quite happy to provide liquidity. They're not facing any risk of you knowing more than they do. So to signal that there really is no private information, you should basically pre-announce the trade. And also by pre-announcing the trade, you give liquidity providers just time to prepare, right? So it's probably not a good idea to catch everyone by surprise. Instead, you let liquidity providers prepare. And so the conclusion of the studies in Petayistos is really to say that if you make your index a silent index, okay, so basically you're trying to be quite secretive and avoid that transparency, you will actually be on the wrong side of both of these effects. You'll be on the wrong side of signaling to liquidity providers, because they may get the idea that the trades now are due to some private information that they don't have. And also you're on the wrong side of allowing providers to prepare. And so you may catch providers being unprepared to accommodate the liquidity demand. So the implication of this is really that transparency helps keep costs down, is not something that will generate extra cost. Definitely, if you think about the kind of economic rationale behind that. So if you think about factor indices, I already said that it's unlikely that there should be price effects, clearly because there is no private information, but also think about cap-weighted indices. So here we have evidence of price effects because of this certification effect. Now, should we think that there is a certification effect because a stock is included in a factor index? Well, definitely not, right? It's just included there because we're following a mechanical strategy. So if the stock is included today, it could be kicked out at the next rebalancing. That all depends on the stock characteristics, and so there definitely isn't any benefit for a investor relations professional to announce that we are a real blue chip company because we've just been included in the momentum factor index. So these kind of effects should not apply. Demand pressure for tracking factor indices could be substantial, but the demand pressure really depends not only on the assets tracking the indices, but also depend on the index design. So lots of indices come with investability rules, and that should keep demand pressure low. And also it's been shown in recent papers that, especially if you think about multi-factor portfolios, there is a trade diversification. Okay, so by having these multi-factor products that actually combine exposure to different factors, a lot of the trades actually cancel out. So if indices are properly designed to account for these investability issues, you wouldn't actually affect a high demand pressure in the first place. And that also leads us to believe that there shouldn't be a major issue with price effects. We've looked at this empirically. So what do the price effects look like for scientific beta multi-factor indices? So these indices have been live since 2012. So there have been assets under replication that have gone into these indices and have grown over time. And so we're interested in getting a measure of the price effects. So we applied the standard methodology from studies of cap-weighted indices, and we just looked at whether stocks that the index buys will indeed get an increase in price or will get an abnormal return. We're comparing here the results for the cap-weighted indices with those of the multi-factor indices, and you can see a very clear, very striking difference. So in studies on cap-weighted indices, you can see that stocks with buying pressure from the cap-weighted index, so index additions, typically have an abnormal return of something like 1.5% to 2.5%. And you also see the confidence bound around these estimates. So the confidence bounds are fairly wide because index additions to a cap-weighted index are quite rare. Okay, the index it's supposed to be buy and hold. It doesn't rebalance often, but there's still reconstitution. And so we can measure these effects. We don't measure them very precisely, but despite that, they're definitely positive. We definitely have evidence that there are substantial price effects. Now, if you look at the sine beta multi-factor indices, you can see that the price effect is very close to zero. So if you look at these graphs, the numbers will be around a handful of basis points, either positive or negative. But also we can measure these price effects very precisely. Why? Because the indices rebalance on a regular basis. So we actually have lots of rebalancing activity. Is not just about index additions and deletions. We actually we have increases and decreases in weights on a regular basis. So we're also able to measure these effects quite precisely, and it's we can conclude that there is zero price effect over that period. That's not surprising, given that there's no private information, and also these indices have some investability rules. So just let me conclude by considering some of the alternatives that are proposed by some of the proponents of kind of crowding problems. So a lot of this theory where industry participants say that crowding is maybe a problem, is a problem or could be a problem, and may lead to crashes and so forth. As I said, this is pure theory. It's not something that has been backed up by data. But on top of this, describing this problem, what these claims also do is they basically, propose alternatives. And so one alternative is, well, since we have this crowding problem, we should really go back to active management, and active management will not have these concerns. And so here I'd just like to point out that there's really no reason why crowding should be a problem for systematic factor strategies, but not for discretionary managers. So just for example, discretionary managers typically follow much more dynamic strategies. So if you're more dynamic, how does it create less buying pressure than the more passive index-based strategies? And another point is that an idea behind saying that active managers will not generate crowding concerns is that, well, because they're behaving different. So one active manager is completely different from anyone else. He's not transparent on what he's doing exactly. Well, we know that quite often these systematic active funds come up with very similar strategies. And so there's lots of evidence that there actually are some adverse effects that active managers use the same data and the same models. And so there's really no reason why active managers would actually avoid any of these crowding concerns. So what I really tried to show is that we do have evidence on this question, whether or not there's crowding. So again, I think it's a really interesting question. And what's really interesting is that we can go to the data and we can check out whether, as of today, there has been or there has not been crowding. Factor investing is widely followed. And looking at post-publication returns and looking at index rebalancing effects is really a very pragmatic way, I think, to assess this question. And it helps us just go beyond this theory, this kind of stories saying that, well, because everyone does the same, then the premium should maybe disappear. So this is really, I think, it's good to look at the data and see whether we can conclude anything as of now. And so what I just tried to show is that we have good ways of analyzing whether crowding has disappeared. And I think for investors, what this means is really that transparency is key. So the crowding concerns really start off with saying that there's probably something wrong with too much transparency. Well, I would argue it's actually the opposite, is that we should have more transparency, because if index providers are completely transparent and provide a lot of analytics on how the indices behave, if they provide analytics, for example, on what happens during the rebalancing of the indices, similar to the kind of analysis that I've shown, well, then we would rely less on stories and anecdotes, and we could rely much more on actual evidence. And so instead of kind of blaming transparency and putting suspicion that transparency may hurt, I think investors would benefit from even more transparency in the area of factor indices. Thank you very much for your attention.